Have you ever wondered how some real estate investors seem to move from deal to deal without running out of money? It's not because they're all loaded. In many cases, they're using a financing tool called a hard money loan. Traditional loans can take weeks or even months to close. For real estate investors, especially those working on flips or distressed property, speed matters. Hard money loans exist to solve that problem. They're designed to close fast and focus more on the deal than the borrower's personal financial history. Hey guys, this is Zayden Wong with RSC Private Lending. I'm a hard money lender and I've placed hundreds of millions of dollars into real estate projects for investors across the nation. And today we're going to discuss how to get hard money for your project. In this video, we're going to break down what hard money loans are, how they work, their pros and cons, and what lenders look for before approving a deal, so you can decide if this type of financing makes sense for your next investment. What is a hard money loan? A hard money loan is a short-term real estate loan commonly used by investors who need to purchase property quickly or renovate properties that don't qualify for traditional bank financing. Conventional loans at banks usually require 2 years of tax returns, proof of income, strong debt-to-income ratios, and a property that is in really good condition. Hard money lenders understand that many investment properties need work and that many investors don't earn income from a traditional W-2 job. Instead of focusing heavily on personal income, hard money lenders primarily evaluate the property and the deal itself. Hard money loans are commonly used for fix and flip projects, outdated properties, time-sensitive purchases, short-term investments. One major benefit is flexibility. Hard money loans do not rely on debt-to-income ratios, which means investors are not capped based on personal income. As long as the deal works, lenders may still approve the loan. Hard money loans are generally more expensive than traditional financing, with interest rates around the 9 to 12% range. But these loans are typically interest only, which keeps the monthly payments more manageable. In addition to interest, borrowers should expect to pay processing fees, which are around $1,500 to $2,500, origination fees, which end up about 1 to 3% of the loan amount, and then broker fees if you are going through a broker. These loans are also short-term, commonly lasting 6 to 12 months. That means you need a clear exit strategy, either selling the property or refinancing into long-term financing before the loan matures. Before issuing a loan, hard money lenders generally require a pre-screening questionnaire to understand both the borrower and the deal. They'll ask for information like the basic contact info, how the property will be purchased if it's a LLC, a partnership, a trust, proof of entity documents if applicable, such as your operating agreement, articles of organization, certificate of good standing, then also sources of funds for down payment and closing costs, and then lastly, understanding your credit score. While credit requirements vary, higher scores generally result in better loan terms. Some lenders don't check credit at all, but those loans usually come with significantly higher rates and fees. Lenders also want to know about your real estate experience. Experience usually means completed deals where your name was on title, not related roles like wholesaling or contracting. They'll also evaluate your liquid reserves, which may include cash, stocks, or retirement accounts, but those are often counted at a discount. These reserves are used to confirm that you can cover the down payment, closing costs, renovation budget. This protects the lender by ensuring that you can complete the project without running out of funds. The next thing lenders are going to evaluate are going to be the property type, whether it's a single family or a duplex or a fourplex, etc. And then the occupancy status, if it's currently vacant, which typically these are. The purchase price, if there are assignment fees, if it's a wholesale. What's the renovation budget and the scope of work. And then the timeline for repairs and the after repair value. Most lenders, when looking at deals, prefer loans stay under 75% of ARV, which provides a good cushion and margin of safety and helps ensure the profitability. Newer investors often qualify for around 80 to 85% of the purchase, while more experienced investors may qualify for up to 90% of the purchase price. And whether you're experienced or newer, you'll always have 100% of your renovation budget financed by your lender for fix and flips. Lower leverages, on average, typically come with better rates, while maxing out the leverage available will come with slightly higher costs. If you're looking to get better loan terms or improve your loan terms, some good factors to consider would be maintaining strong credit, having more completed deals under your track record, so just continuing to do more deals, communicating clearly and professionally with your lender, and building that relationship. Loan officers in general are more likely to advocate for borrowers who are prepared, organized, and easy to work with. Some final thoughts here that hard money loans are a powerful tool when used correctly. They allow investors to move quickly, fund properties that banks wouldn't touch, and scale faster when time matters. The key is understanding the structure, costs, and expectations before committing. When the numbers work and the plan is solid, hard money can be an effective bridge to profitable real estate investing. If you found this helpful, let me know in the comments. And if you want to learn more about hard money or want to apply for a hard money loan, click the first link in the description. Thanks for watching.